Good afternoon, everyone. Thank you for joining us. We have a great program. This is our second series in our high net worth webinars. This seminar is timely. We're going to be talking about estate planning strategies and updates. It's timely because President Biden just issued new proposals last week that can have an adverse effect on any estate planning strategies that you're thinking about implementing. So like I said, this is our second part of our series. Next month, we're going to be talking about cryptocurrency, and then we're going to do some tax updates in November. So I'm going to introduce Kevin Matz. Kevin is a partner at Schiff Harden, a New York law firm. Kevin is a trusted advisor to clients with significant wealth, and he focuses on domestic and international estate and planning strategies. Kevin is an industrial leader, and he's been recognized in the 2020 Chambers High Net Worth Guide, where insiders say he's absolutely brilliant, responsive, and a pleasure to work with. What more can you ask for? Kevin is our East Coast guy. We have another attorney that's coming on that got delayed, Robert Strauss from the West Coast. Hopefully Robert will be joining us shortly. And we have Mary Delman from Citron Koopman. Mary is a principal in our trust and estate department, and is always involved in estate planning strategies and trust issues. So without further ado, I'm going to turn it over to Mary. Please ask a lot of questions. You know, this seminar is extremely timely because of those new proposals that were issued last week. So, you know, we're still vetting those and still going through those. So there's still going to be a lot of open questions, but Kevin has a vast of knowledge, and he's already gone through a lot of these proposals and can give you a lot of great insight. So Mary, please take over.
Thank you, Pat, and welcome everyone. As Pat mentioned, this is perfect timing for this webinar. So, we have some, before I get started with the webinar, we have some housekeeping points to go through. So this webinar should last an hour, so we should be getting one CPE credit for this webinar. There'll be 3 polling questions throughout the webinar, and they need to be answered so that you can get your CPE credit. So please answer them when they pop up. Everyone is in listening mode today except for the presenters. And you will have the opportunity to submit questions to our presenters. You can type them into the Q&A panel on the bottom of your screen. And you can also raise your hand and we can open the microphone, but I think it would be easier just to post the questions in the Q&A down below. Okay, I think we are now going to our first polling question. Will you require CPE for today's webinar? Ryan, how are we doing with the responses? Oh, there we go. Okay. All right, great. So here's how this webinar will work. Kevin Matz is going to start us off with an overview of the proposed legislation that was released on September 13th. This will just give you some background as to some of the proposed changes for the estate and gift tax world. And this proposed legislation, actually, there are a lot of questions that are unanswered. So everyone has a lot of questions and concerns related to it. So please feel free to ask your questions. We hope to answer them. Some questions, unfortunately, we can't answer because we just don't know at this point, but we'll do our best to give you our educated guess as we go through it. And once Kevin goes through a summary of the legislation, then there are certain topics we'll be discussing between Kevin and Robert and see if they can give us some of their opinions on how to proceed with different matters. So Kevin, I will turn it over to you.
Okay, well, thank you, Mary. Thank you, Pat. And hello, everyone. So this is a very timely program, as Pat and Mary have stated. Just last Monday, So September 13th, we got this nugget from the House Ways and Means Committee, and nugget in terms of well over several hundred pages of proposed tax legislation that would dramatically affect what we do as far as working with clients and families and high net worth individuals and planning, the estate planning, the tax planning, and taking account of what principles are we accustomed to, what are the concepts that we're used to regarding exclusions and like regarding estate tax inclusion, the use of grantor trust, the use of discounts, and turning a lot of those concepts on their head. And there are four main provisions of this proposed legislation, which again is keyword proposed, okay? This is just I consider it a draft from the House Ways and Means Committee. Has not passed the House. It's being marked up right now. Marked up means literally what it sounds like. They're saying, nah, let's eliminate that. There are errors here. Let's eliminate that. Maybe let's consider the state and local tax deduction limitations. Maybe put that in, and everything is being horse traded right now as to that. And again, the way the process works, let's say you have something that passes the House. Does that make a law? No. It has to then go to the Senate. And the Senate is, again, it can all be done through the reconciliation process solely by Democrats. But the majority in the Senate is incredibly tenuous. Why? Because it's 50-50 with Kamala Harris, the vice president, serving as a tie-breaking vote. But you have to have all 50 Democrats on board, and you have moderates such as Joe Manchin from West Virginia, Kirsten Sinema, also Democrat from Arizona, both of whom, just going back the last 7 or 8 years, they actually voted in favor of repeal of the federal estate tax. So understand that you have to get it through them. So right now we're at the House level, not even at the full House level. Proposal for the House Ways and Means Committee. What does it provide? There are 4 key provisions that affect estate planning. Listed them here. We're going to dig in on certain of them. Number 1, termination of the temporary increase in unified credit. What I'm talking about there is, as we sit here today, each U.S. citizen or resident has an $11.7 million applicable exclusion amount for estate, gift, and generations gift transfer tax purposes. For a married couple, multiply that by 2, that's 23.4 million. What does that mean? It means that you could pass free of gift tax during your life or estate tax on your death up to $23.4 million for a married couple, $11.7 million a piece, and not have to pay a cent of either gift tax on lifetime gifts or estate tax on death. Now that is a temporary amount. It's a temporary amount that was increased by the Tax Cuts and Jobs Act 2017 from 5 million to a double level, 10 million plus indexing. The indexing gets us to 11.7 million. The way it was done with the 2017 tax legislation was that in order to come within the confines of the tax reconciliation bill, it had to sunset after a certain point in time. And that point in time was after December 31, 2025. After that sunset, it would simply go back to the 5 million as indexed figure, which is where we were prior to 2018. What is proposed here is that there would effectively be a move up of that sunsetting from December 31, 2025, cross out 2025, right in 2021, and that's what's being proposed. As of January 1, 2022, we would be looking at, if this proposal were to be enacted, of having an exemption probably in the neighborhood of a little bit more than $6 million. I've seen the figure 6,020,000, still subject to confirmation, but that's what we're looking at. What does that mean? 11.7 million today, 23.4 million for married couple, going down to 6 million and change, maybe call it 12 million change for a married couple. That's going to create a huge demand to make gifts while we have the expanded exemption now by December 31 in order to effectively use it or lose it as far as that exclusion amount is concerned by the end of the year if this were to pass. So that's what that pertains to. The second item, just very, very briefly, if you have real property that's used in a family farm, or also a family business, doesn't have to be a farm, it could be a business, there is a tax relief provision under the Internal Revenue Code that says that you can value it based upon the actual use to the business, to the taxpayer, as opposed to what it could get under fair market value principles if you went to an appraiser and all put it on a market and perhaps at a better, more optimized use for the property. Right now, that exclusion is $750,000 in the current law. What this proposal would do is that actually would be taxpayer friendly. It would increase that exclusion from $750,000 to $11,700,000. Two more items, and this next time I'm going to drill down. We're going to drill down quite a bit. Okay, so the rules regarding grantor trust, basically, they're trusts that for income tax purposes are treated as one and the same as a taxpayer, but quite often for estate tax purposes, they're not considered one and the same. They're to the other side of the so-called proverbial tax fence. We love planning with grantor trust. We're going to talk about this in a moment, but there would be severe restrictions that would cause grantor trust status for new trusts created after date of enactment, or contributions to existing trust after date of enactment to be brought back into one's taxable estate for estate tax purposes. It would also cause distributions out of such trust, again, post date of enactment, to be taxable gifts unless they are to the grantor or the grantor's spouse. And then if you have a sales transaction with such trust, there's a provision that would say that ordinary rules that have existed since 1985, the Internal Revenue Code, that cause them not to be taxable, well, they would be basically written out of the code. They would be superseded by a new provision that would say that that sale to the grantor trust would be a taxable event. And then the fourth provision here deals with a subject that's near and dear to many of us: valuation discounts, discounts for lack of control, lack of marketability. And those are real discounts. If you try to sell an interest where you have a limited partnership interest or an LLC membership interest and you don't control, are you going to get 100 cents on the dollar? No. Our appraiser friends will tell us that usually you'll get closer to about 65 cents in the dollar. What these rules would do is it would say after date of enactment, whenever that may be, if that day ever comes, those discounts would not exist in the case of non-business assets. Think in terms of marketable securities partnerships, think in terms of possibly even real property type partnerships or LLCs, and transfers of interest in it where it's not considered to operate a trade or business. So let's drill down a little bit, in particular on the grantor trust rules that I mentioned. So there are two different aspects to it. And as mentioned, there's a new proposed section 2901 of the Internal Revenue Code, which would say that if you have a grantor trust and it's either you create it after date of enactment, or it's an existing trust that you make additional contributions to, talk about what a contribution is before too long, after date of enactment, that all gets brought back into one's estate for estate tax purposes. Again, we love planning with grantor trust because it allows us to deal with a trust that is considered one and the same as us for income tax purposes, but be on the other side of the fence for estate tax purposes, which means you get all the growth on the other side of the fence. Congress is concerned that effectively there's a built-in arbitrage there, that you're having your cake and eating it too. And it seems as though, at least in view of the tax writers, what they've done here is they said that if you're going to have a grantor trust, in most cases, you're going to have estate tax inclusion for it. Now that is far reaching, because what a grantor trust, we'll talk about it soon, but that could include trust in which a spouse is a beneficiary in most instances, spousal lifetime access trust. It can include life insurance trust. There's a provision in the Internal Revenue Code that says that if you have a trust that could pay life insurance premiums out of income, that automatically causes it to be a grantor trust. This is very serious stuff. I would imagine that the insurance lobby is all over right now, and in fact, I'm pretty confident they are, but this is very serious stuff. The other aspect, the other code section that would be created here, or effectively created, would be section 1062, that would say that when you have a sales transaction with a grantor trust, right now under current law, that is not a taxable event. That is not considered a taxable, it's a tax nothing. It's like dealing right pocket, left pocket. We love to plan with it accordingly, because again, You can shift assets by virtue of a sale for full and accurate consideration. It's a nothing for income tax purposes, even though there's a lot of appreciation what you sell, but you're getting it to the other side of the tax fence. All that growth is outside of one's taxable estate. Also, because it's a grantor trust, you pay income taxes on it. The grantor pays income taxes on it. Same effect economically as a deemed gift to the beneficiaries of the trust, but it's a tax nothing. So we have guidance from 2004, which the IRS says that you don't even have to worry about it. You don't have to worry about it. It's generally a tax nothing, except in very rare circumstances. This would shut that down. This would say that if you have a sale to a grantor trust, and it's a newly created grantor trust, or one for which there's contributions after date of enactment, still the contours of that are a little bit unclear, but that would be considered a taxable event and basically take away the technique of sales or even swaps via power substitution to grantor trust. Now, digging into section 2901, there are four main provisions here. And this is a provision that causes grantor trust to equal estate tax inclusion. Usually not the case here unless it's a trust that is revocable, or it's a trust in which a grantor is a beneficiary. It's not created under an asset protection trust jurisdiction or state's law. So this would say that if you have a grantor trust, there are four main attributes. Number one, you're going to have estate tax inclusion with respect to the portion of the assets that are attributable to contributions after date of enactment, or in the case of newly created after date of enactment, post date of enactment, grantor trust. Grantor trust equals estate tax inclusion. That is a major seismic shift in the landscape here. That's the estate tax. So the question then becomes, well, can we avoid that by making distributions out of that grantor trust during the grantor's lifetime? Bullet 2 here, no, you can't. Any distribution, if it's not to the grantor or the grantor's spouse, and isn't in discharge of an obligation of the deemed owner, think in terms of the grantor here, that is going to be considered a gift for gift tax purposes. So it's a distribution that goes out. Usually a distribution is not a taxable event for gift tax purposes. It's the contribution to the trust, which is a taxable event. This would say that distribution out is going to be a deemed gift. Third, if you ever say, oh, you know what, I'm concerned here, I'm going to shift from a grantor trust to a non-grantor trust, so this way those rules that ensnare grantor trust won't apply to me. Well, you can do that, but at the cost of that shift, again, for a post date of enactment trust or post date enactment contributions, constituting a gift of itself. And then the fourth point here is that, well, to avoid duplicity, to avoid basically double inclusion, let's say there's a gift initially into the trust and then a deemed gift under these rules on a distribution, there's going to be an offset. And Congress seems to be, the tax writers seem to be mindful of that and will provide an offset. Now, where these rules don't apply is that's the bullet at the very bottom. If you already have amounts, already have a trust that is includable in one's gross estate without regard to this section, then you don't worry about it. But that's not the headline that people are focusing on. They're focusing on the fact that grantor trust, as an effective planning tool, could be largely shut down under these proposed rules. Section 1062, so that again is a companion provision. What we like to do is we love to have sales to grantor trust, take back a promissory note, have the promissory note pay the so-called applicable federal rate on the Internal Revenue Code, whatever it is from month to month. And if you get the fair market value right by virtue of appraisers, or maybe you have formula, defined value formula clauses built in, that's not going to result in a gift. And also because you're selling to a grantor trust, is it a taxable event to the grantor who sells it? No, because there's a revenue ruling, 8513, going back to 1985, that says it's a tax nothing. Right pocket, left pocket of the same person, it's a tax nothing. This would overrule it as far as the sale or exchange treatment is concerned. It would specifically overrule it, except in the case of trusts that are fully revocable. And then the question then arises, well, can you use it to manufacture a loss? No, there's a provision here that says you can't do it to manufacture a loss. I see we now are up to a polling question.
Yes,
Mary?
thank you. Thank you, Kevin. So our next polling question. Will the September 13th legislation affect the step up in basis at death? A, yes, B, no.
It's interesting. It says host and panelists cannot vote. I guess I can't vote on this.
No,
Although
we
I
can't.
will address the answer.
I guess we'll give everyone a few minutes to respond.
I'm going to throw out some of the questions before you start that some people are answering.
Okay, great.
In your opinion, this is the question, are Grantor's trusts finished?
No, not yet. It's not all she wrote. I can tell you that a number of groups are in touch with folks who are writing the legislation to express their views. And those, it may be that perhaps all trusts will be treated except for certain types of trusts, such as trusts in which the beneficiaries are limited to a narrow class of individuals, such as the grantor and the grantor's spouse. As non-grantor trusts, it may be that I know a proposal is that an election could be made. You could elect grantor trust treatment or non-grantor trust treatment, and this way, presumably, that should be satisfactory to Congress and the tax writers because you're not gaming the system. There's no arbitrage. You're either one side of the fence or the other. So this has to play out. This absolutely has to play out, okay? But it's something to be aware of. I think regarding the exemption going down, I think that is the very low hanging fruit. That's going to sunset anyway after 4 years. That's something that a number of us have looking into our crystal ball, as foggy as may be. That's easy, to basically scale it down after December 31, which means there will be, if that happens, there would be a use it or lose it as we get to the end of the year. And it's already second half of September now. So that's something to bear in mind.
Okay. All right.
Okay. So moving.
I guess we need the results.
Okay.
Oh, here we go. Oh, okay. I'll let Kevin continue.
Aha. Interesting. Can I give away the answer? Well, you know what? I'll give away the answer now. I should have there's no one gets penalized, right?
No. You can give it now.
It's okay.
Okay.
It's okay to be wrong. Okay.
Yeah.
All right. This does not affect step up in basis. Everything in the Biden administration Green Book that came out at the end of May that talked about at death, if you have appreciated property, it's a deemed gain, or if you make a gift of appreciated property, it's a deemed capital gain. None of that's addressed here whatsoever. And from what I've heard anecdotally, there just is not support, including in the Senate, where again, it's so tenuous. You need all 50 Democrats to agree. It doesn't look like that's happening. And it looks as though there's nothing that would limit the ability to get a step up in basis on death. So that's sort of the good news that came out of this. We'll talk about some other good news items too. But let's see.
Okay, I guess we can continue.
Okay, so continuing on. Now, there's I think a fundamental flaw with the way this proposed legislation has been drafted. It assumes that in our planning, we could choose grantor trust or non-grantor trust, and we're choosing grantor trust because we want to have our cake and eat it too. We want to have grantor trust, irrevocable trust. We're always talking about irrevocable trust. If it's revocable, it's automatically it's still a grantor trust, but it's automatically brought back into the estate without regard to the section. We're talking about an irrevocable trust that is treated as one and the same as me for income tax purposes, but on the other side of the tax fence for estate and gift tax purposes. It looks as though that Congress or the folks in Senate Finance Committee who are writing this are assuming that it's very easy to choose grantor trust or non-grantor trust treatment. That's not the case. We'll talk about it in a moment, but often there's no such choice, especially when you consider the assets that may be held by the trust, think insurance, life insurance, And if you want to include your spouse as a beneficiary, it's usually not going to work. Now, what does this harm? What does this harm? So this would harm, as mentioned, irrevocable life insurance trust. It's because it's almost automatically a deemed grantor trust under section 677A3 of the Internal Revenue Code. Grantor charitable lead trust. So you have a charitable lead trust, you make it a grantor trust so that this way contributions to it would be a tax nothing, but distributions out to charity would generate a tax deduction. That's not going to work here. One of our favorites, spousal lifetime access trust. We love our acronyms. We call them SLATs. What am I talking about here? The client comes to me, says, I hear it's use it or lose it with my exemption. I want to use it now so that this way I can make a tax-free gift before the 11.7 that's available to me for my wife, 23.4 million, goes down, careening down to 5 million as index, probably a little over 12 million as of January 1. Well, that's fine. But here's the thing. I need a backdoor protection so that if I make a gift and let's say I fall in hard times, I at least want my wife, around, it could be my wife making transfer, the husband is a beneficiary so that distributions can be made, or maybe a home could be transferred to it. And this way the spouse can live there. And as long as the spouse doesn't die, and as long as the marriage remains solid and on good terms and doesn't go south, that, you know, that provides some so-called rainy day fund backdoor protection. We're not going to be able to do that here because the rules are set up so that anytime a spouse is a beneficiary, there's a so-called spousal unity rule and the grantor trust rules that impute that power or interest to the grantor. And the only time that's going to work to create a non-grantor trust is if distributions back or powers have to be done with the consent of so-called adverse party, which can be done. The adverse party could be a child who has an interest, but has to be a very substantial interest. And that lessens some of the appeal because the ability to have it as a rainy day was a rainy day unless someone's in a bad mood, right? Who's directly affected by it. So that really hurts the planning. Lifetime qualified terminal interest trust, basically much the same thing, much of the planning that was done when we're concerned about retroactivity. I think it's fair to say we're no longer concerned about retroactivity at this juncture. But much of the planning involved earlier this year involved these trusts to allow further elections concerning whether to treat as a gift, as a taxable gift, or not to treat as a taxable gift. Because it's a spouse is involved, planning's not going to work too well. A couple particular provisions, techniques that are set forth into the Revenue Code: grantor retainer annuity trust, qualified personal residence trust, not going to work at all. Theoretically, you can create it. You can maybe have someone other than the grantor or the grantor spouse as having the current interest. It could be another senior family member, but then you have a taxable gift going in. It becomes a big mess and probably won't work. And here, a couple of the complications. So I alluded to that spousal unity rule, which automatically creates grantor trust treatment whenever a spouse is a beneficiary, unless you have a trustee who's a so-called adverse party whose interest would be adverse to the exercise of power. So lots of the flexibility would be gone. And then as far as being able to achieve this, there's also a toggle rule under section 674. I don't want to get too technical, but that looks to see who the trustees are. And if there's a change in trustees from time to time, you could start out as a non-grantor trust, but ultimately find yourself in the grantor trust world. So that's a big problem that I don't think the tax writers fully thought through. Now, effective date, when does this apply? Very important. So according to the proposed provisions, again, this is still proposed. This is proposed legislation, but it talks about when it would apply as far as not the capital gains provisions would be going back to December 13th, but here in the estate and gift tax world. So it would apply for trusts created on or after the date of the enactment. And also it would apply to any portion of a trust established before date of enactment. And again, date of enactment is when it gets signed into law. We don't even know if it will get signed into law, but if that happens sometime later this year, that would be that date of enactment, which is attributable to a contribution. See that word underlined and in red, contribution made on or after such date. What's the contribution? That's a 64,000, maybe 64 million or $64 billion question. It's very interesting because if you look at the explanation provisions, it doesn't use that word. It talks about future trusts and future transfers being subject to this. But the actual language of the bill uses the word contribution is a sale or exchange contribution for a promissory note, fair market value, if it bears interest at the required rate under tax law principles, applicable federal rate. Is that a contribution? I don't know. The exercise of power to swap assets, which is one of our favorite Grantor trust triggers, and that's for fair market value. Is that a contribution? I don't know. Yeah. And what about if you have a family entity set up and you each make a capital contribution to it, including through the Grantor trust? Is that going to be a contribution? It sure sounds like it. So it makes me nervous as to that. We already talked about discounts. Discounts would effectively go by the wayside as far as non-business assets. If you have a trade or business, different story, or but there's also a look-through rule that could potentially apply for 10% interest or greater interest in other entities on a tier level. I know those rules are still being worked through. I understand, but understand that the discounts that we love to factor into our planning, by and large, unless you have an operating business, an active trader business, would go by the wayside. And that too would be after date of enactment, whenever that may be. Not as of now, but perhaps some point later this year, later the fall. Importantly, what's not included? So I touched on this, and that was also part of the subject of the, I was going to say trivia question, I guess a poll question, but it might as well be a trivia question too. So what's not included? So the maximum tax rate would stay the same. It would be 40%. There's no proposed changes to generation skipping transfer tax. Some of the proposals prior to this had talked about, well, maybe you have if you have a trust that terminates after 90 years, perhaps at some point in time there would be a generation skipping transfer tax imposed. None of that here. There had been some concerns, including in Senator Bernie Sanders' proposal before the 89.5% Act, that would reduce the gift tax exemption all the way down to 1 million for the estate and generous skipping transfer tax exemption, 3.5 million. Did not happen here. We're looking at 5 million as index all the way across the board. There were also some proposals made that would limit the ability to have annual exclusions on transfers to trusts by looking at things not on the per donee or beneficiary recipient basis, but rather at the donor level. Not applicable, did not apply here. And then the subject of our trivia / polling question for CPE, nothing here, nothing whatsoever that was part of the Biden administration's Green Book proposal that would cause death or gifts to be a taxable event for income tax purposes for appreciated property to the extent of the appreciation, a capital gains tax event. Nothing here. There's also nothing here that would otherwise limit step up in basis on death. So what's the import overall? What are the, as they say, changes are in the air, right? It's sort of like Bob Dylan's blowing in the wind, right? So this is the time to plan. Realize that the exemptions, the doubled exemptions, are scheduled to sunset after 2025. It would not be hard for Congress to move that up to after December 31, 2021. I think that's the most likely to happen. But there could also be changes with discounts, limiting discounts unless you have an active trader business, and also, as mentioned, with Grantor Trust. If you want some more information, my partner Stephen Liss actually has an article that he wrote on this, which is the link for which is stated there. And I think with that, Mary, I'll turn things back over to you.
Okay, thank you, Kevin. That was very informative, a lot of information, but a really good overview of what's in front of us. And as Kevin stated, this has presented us with a lot more questions than I think the information we've been given. So Kevin, if you could just advance to the next slide. I think we have our next polling question. Oh, here we go. Okay, this is an easy one, I think. Do you believe that you have enough information to advise your clients about potential estate tax reform?
Is there a C? It depends, or no?
Yeah, yeah, A, yes. B, no. So I think, I'm not sure we have enough information. Okay, I think the poll just launched. While we're launching it, I'm going to say hi to Robert. And I'm going to throw a question or just a thought over to you. And we've had a lot of questions about this already. So, Kevin spoke about there's a significant focus on grantor trust, as we heard, with this proposed legislation. So what can be done with existing grantor trusts, like slats and grats and islets, to avoid, what's next to come with these additional taxes if this proposed legislation is enacted?
That's a great question. First, I think Kevin just gave us a tremendous summary of what this proposal is. And I also think he did a great job of continuing to emphasize that it's a proposal. And we all have to remember that. And as we're giving advice to clients, or as clients are accepting advice, we have to be really careful that we continue to emphasize that this is a proposal. It's not a fait accompli. And that's going to impact the way people respond to the proposal. And we're having these conversations with clients every day, and many, many times a day, as you can easily imagine. I think what to do literally leaps off the page following Kevin's summary. The idea is that what the House has proposed is basically to eliminate the effectiveness of grantor trusts, really the additions to grantor trusts, whatever that term means, from and after the date of potential enactment. And so the solution is, first, clients really need to think seriously about using their exemptions now, before potential enactment. And we're having this conversation with clients literally every day, as I said. And the advice to clients is you got to think very seriously about using your exemptions before the end of the year. Of course, that means in many cases creating new trusts. It means in most cases identifying assets, arranging for appraisals. And here we are on September 23rd with not that much time left before the end of the year. I actually got started with this kind of advice before last November's election and have been having these conversations now for like 15 months. And people respond or they don't respond, and people are really starting to respond now. So the idea of using the exemption by making gifts first. Second, making gifts into grantor trusts makes a lot of sense. It continues to make a lot of sense, and it will continue to make a lot of sense even if this legislation is enacted, because of the grandfathering that's been allowed. So for all the reasons that we like using grantor trusts, right? The grantor gets to pay the income tax on behalf of the kids. We're able to sell assets into grantor trusts in a non-taxable transaction. We're able to leverage generation skipping. We're able to take advantage of valuation discounting. All those reasons, it makes sense right now for clients to, in a kind of an urgent way, very seriously consider either creating the grantor trusts or loading them up. I will tell you candidly, we haven't done very many QPERTs over the last 10 years or so, because those are structures, first, that work more effectively in a high interest rate environment, and we've been in a very low interest rate environment. Second, you have to survive the term for it to work, and so there's mortality risk. Third, they can't be generation skipping exempt. And fourth, if you run the math, you can produce a better result instead of doing a QPERT, gifting or selling to an intentionally defective grantor trust. You got to think about that. GRATs, I think, continue to be, for now, unless and until this legislation passes, very viable structures. And the way I've been thinking about GRATs, and maybe not everybody agrees with it, but the way I've been thinking about GRATs is because they are permitted under the Internal Revenue Code to include an automatic valuation adjustment clause that is code-based and is not dependent upon a court saying, yes, the Wandry clause is valid or is not valid. When we have an asset that is particularly susceptible to valuation risk, like, for example, a client is selling a business and we get an appraisal today that the that the stock that the client owns, I'm just going to make up numbers, is worth 4, but in the actual transaction, it's worth 19, right? And you're contributing that stock to a GRAT a relatively short period of time before the transaction is consummated, you have a lot of risk that the IRS is going to assert that the stock was not worth 4 when you contributed that stock to a GRAT, but is really worth much more, like 19 or much closer to 19. We love GRATs in that context because if the IRS does challenge the valuation, the GRAT will automatically adjust and always produce a 0 gift. And that is still a viable strategy today. I'm happy to discuss GRATs in greater detail, but if the House proposal passes and eliminates the use of grantor trusts in the estate planning context, we won't be able to do that in the future. So I imagine folks with hard to value assets or assets that they think are going to explode in value in the near term should be focused on GRATs right now, perhaps to the exclusion of direct gifts to intentionally defective grantor trusts, even with Wandry protection, perhaps to the exclusion of sales to intentionally defective grantor trusts, even with Wandry protection. So we're having these conversations every day, and I've been sharing with my partners that I kind of approach it like this. This is a tremendous oversimplification, but our clientele seems to fall into 3 buckets. You've got the extremely wealthy clients who should have been doing this planning all along. And what's happening in Washington is now serving as motivation to get them to finally do this planning. You have the folks at the other extreme, very few of whom are probably clients of Citrin Cooperman, very few of whom are clients of our firm, but we have some legacy clients who just simply don't have enough assets and don't have to worry about them. And then there are the folks in the middle, the folks who absolutely would be negatively impacted if the exemption does fall the way we think it might, but who maybe can't afford to give away assets to their kids in order to capture the exemption before it falls. And we're having a lot of really difficult conversations with those clientele in order to help them sort through, whether there are steps that they can take. And the SLAT is a pretty viable strategy for many of those folks, not for all of those folks. And Kevin did a pretty good job of summarizing the crux of the SLAT. And for me, the crux of the SLAT is this. Sure, husband can create a SLAT for the benefit of wife and fund that with the exemption. And similarly, wife can create a SLAT for the benefit of husband and fund the exemption. And if you can manage to avoid the application of the reciprocal trust doctrine, and that's a whole discussion in and of itself, then you've got a viable strategy, which falls apart potentially at 2 different times. God forbid the clients get divorced. Now they're walking away with those trusts, and you have to ask them, even though it's a tremendously emotional and touchy subject, you have to ask them, would that work for you? For most clients, the answer is going to be yes, because it constitutes a pre-division of assets if there were a divorce anyway, so what? But for some clients, the answer is no, especially where one of the spouses is the propertied spouse and the other one is not. And then the second time it potentially falls apart is at death. And at death, the beneficiaries of the deceased spouse's SLAT become the kids. And so the question always is whether the surviving spouse would feel financially secure relying upon just one of those trusts, a SLAT, and whatever assets didn't go into the SLATs. And what I have learned in the course of having these kinds of discussions and conversations with my clients is that there's no such thing as objectivity. It's purely subjective. Like, for example, I have a client who's worth $300 million who is absolutely convinced he cannot gift the exemption amount to his kids, can't afford to do it. Is he wrong? Of course he's wrong. It's an actual operating business that throws off cash flow that's commensurate with that level of value. And he has real estate that's throwing off cash flow commensurate with that level of value. Under no set of circumstances is he ever going to run out of money, but it's not for me to decide. So these conversations are really interesting. I find it hard to believe that at the end of the day, if this legislation passes, that ILITs will be prohibited. I don't think it's the kind of thing that Congress is intending to go after. I would be really surprised if the insurance lobby is unsuccessful in getting this taken away. It just doesn't smack of abusing grantor trusts for estate tax purposes in the same way that we've been able to so effectively create structures utilizing intentionally defective grantor trusts, grats and cuprits and so forth, other types of grantor and slats, other types of grantor trusts, where you could gift and you could sell, and over the course of time, leverage as much of the estate out of the estate as you want. I mean, it's just remarkable what you can actually accomplish. And I'm doing some work for a real estate client of mine right now who's worth 140 million. And his real estate generates 5 million of cash flow a year. So after you take into account valuation discounts and so forth, what you discover when you run the numbers is that if he were to gift and sell all those assets into intentionally defective grantor trusts for the benefit of the kids, and then the cash flows into those trusts and the cash is all used to make payments back to the client on the promissory note, within 11 years, those promissory notes are gone. And if the client's consuming those payments by paying income tax and by living, what does the client have after 11 years? And in this particular case, that client's actually nervous. That underscores two things to me. The first is the tremendous effectiveness of the structure. It completely eliminates the estate tax in his estate, which is remarkable. You can make 140 million disappear just like that. But the numbers expand and contract like that, and you could make any size estate disappear using those kinds of ratios if you have enough cash flow relative to value. And the second thing is, again, you have to be protective of the client. And in this case, the client said, hey, we probably are going to be alive after 11 years. What are we going to live on? How's that going to work? Interestingly enough, for a client worth 140 million, as a consequence of that math, we've shifted our focus from intentionally defective grantor trusts to slats. And yeah, we know we have to get all of this done before the end of this year in order to protect ourselves against the possibility that this House proposal or the Senate proposal actually happens. Bearing in mind, we don't have the votes for it. We may never get the votes for it. We maybe need to believe Manchin and Sinema when they say they don't support it, or maybe not.
All right. Well, thank you, Robert. That was really informative, and I know there's definitely a lot to think about with this new legislation. Pat, do we have any questions? I think we probably need to move the polling question along. I think just to.
I'm interested to see the answer to that question.
Yeah, I know. I'd like to. Oh boy. Okay, well, that's what we're all here for. So, you have all of us to reach out to if you have questions or your clients need to speak with someone.
So I'll throw this one out. I'll go back and forth. Kevin, I'll throw this one out too. What do you think the words deemed owner mean? For example, what if you have an independent trustee? Is the right for the grantor to substitute property within this definition?
So I deemed owner is actually defined for both section 2901 and 1062. Both the estate inclusion and deemed gift provisions and the sale and exchange with a grantor trust being a taxable event provisions. And they refer to a deemed owner under the grantor trust rules, which means that the person who is, be it usually the grantor, but doesn't have to be the grantor, who's considered the owner under the grantor trust rules, the one who sets up the trust, funds the trust, and has the power to substitute assets and like. Now, a deemed owner can also be, and this is very interesting because it applies to qualified subchapter S trust, it could be someone who didn't create the trust, but is nevertheless taxed under section 678 of the Internal Revenue Code as a beneficiary who is likewise a deemed owner. So very interesting. Now, one thing I would note is that I mentioned qualified subchapter S trust, and Mary, I know we were talking about this as well.
Yeah.
To what extent are they ensnared? Well, the first provision that talks about estate tax inclusion that only as written, this is as of right now, as written, it only applies in the case of someone who's a grantor who's a deemed owner. So the qualified subchapter S trust is a deemed owner, but it's not a grantor. So it would not be subject to the estate tax inclusion or deemed gift provisions. It would, however, be subject to the second of the provisions I mentioned, the section 1062 that involves sales or exchanges there, because there's no requirement as currently written, braces as currently written, that there be a grantor involved. It just requires a deed owner.
Mary, I know you have another question. Before I answer these other questions, why don't you throw out that other question that you had to the panelists?
Oh, okay, okay. So back to Robert. So Kevin mentioned that there have been no significant changes for the generation skipping transfer tax and for dynasty trusts. And I know that in prior proposed legislation there was. So what can we do now planning for GST that won't interfere with this new legislation or have adverse tax consequences?
I actually think the potential for the exemption amount to fall underscores the need to do generation skipping planning now. I say now because of the potential, enactment of this legislation. But we can envision through the generations smaller exemptions, which would place an emphasis on the need to avoid estate tax through the generations, which can be done by organizing generation skipping trusts now. It's important to note that GRATs and QPERTs can't be generation skipping, which is another reason to focus away from them. Whereas intentionally defective grantor trusts and slats absolutely can be and usually are designed to be generation skipping, especially in larger estates. So I would focus on that. I would do as much generation skipping planning right now as possible.
Mm-hmm.
And going back to the polling question, we are in limbo right now. And really the best that we can do is give this information to our clients and help them to sort through what they should do. And of course, it's easier for the wealthy clients to take action because they should be taking action anyway. I think that's a no-brainer. The wealthier clients should be using their exemptions in a generation skipping exempt way. The wealthier clients should be selling assets to intentionally defective grantor trusts in exchange for promissory notes. They should stop them. For example, I'm having a conversation with other clients of mine right now, 4 brothers who own like $1.5 billion of real estate. And their immediate question for me is, help us figure out our lifetime exemptions. We want to gift our lifetime exemptions. And my question for them is why? Well, we're concerned about what's happening in Washington. And my response is, well, if you're concerned about what's happening in Washington, then you should also be concerned about your future ability to sell assets to these trusts. So right now you should be thinking about not just gifting, but also selling. They don't understand that yet. And I have a follow-up question with a follow-up meeting with their in-house counsel later today to talk about exactly that issue, the need to sell into these generation skipping exempt trusts so that the bulk of the estate ends up being generation skipping, which will protect succeeding generations from the estate tax burden.
Thank you. Pat, I'll throw it to you with
Yeah, so we have a few more questions. Kevin, I'll throw this one to you. What about the situation where a grantor has an IDGT, has passed away, after the passing and assuming new law, any adverse effect to the beneficiary?
Well, if death is already, so we're assuming that death has already occurred before the law gets enacted. In that case, the trust would not be a grantor trust. It would be a non-grantor trust. And the only concerns would be that if, for example, there were any further planning and it involved transactions, and did you want to try to obtain a discount, you would not be able to do that anymore for passive assets not used in active trade or business. But because it would already be a non-grantor trust, and because the rules as proposed target grantor trust, that situation should get off scot-free.
Okay. 2 more questions. I'll throw this one to you, Robert. Person wrote, this is a grandfathering question. If one now has an existing grantor trust for the benefit of a spouse and children, can one, after 1/1/22, make distributions to the children without it being a gift and substitute assets without it being a gift?
So my understanding is that first, with respect to distributions, that whether you can do that, it pertains to whether there's been a post-effective date contribution. There's not been a post-effective date contribution. If everything that got into this grantor trust happened before the enactment of the law, then you can make these distributions. Whether or not you can do a substitution depends upon the meaning of that term. And as Kevin so accurately pointed out, we don't know the answer to that question. And I'm on pins and needles. I want to know the answer to that question because we do substitutions all the time. And one of the most advanced planning techniques is to look at an existing IDGT that has assets in it that maybe have low basis and high value, and have the grantor buy those assets back for cash and die owning those assets so that they get a step up in basis. I don't know whether we'll be able to do that kind of thing right now, or if this law passes. I just don't know.
Okay. All right.
Robert, I completely agree with you, everything you just stated. From what I'm hearing, there might be an intent that a sale or exchange, which could include the exercise of the power of substitution, may be a trigger for a pre-contribution, rather for pre-date of enactment trust. It's unclear, but I've heard some rumors as to that emanating from Washington. So
yeah, it is unclear, and a substitution technically is not a purchase and sale, but it functions exactly the same as a purchase and sale.
it's an exchange.
Yeah, it's an exchange.
It's not a sale, maybe, but it's an exchange. So
Right.
I'm very concerned that might be shut down for
I am as well.
date of enactment trust.
Yeah, I'm negotiating with a lender right now to borrow $120 million for a client to do this, repurchase of assets. So should I stop? I just don't know. I mean, if the expense would be incurred in connection with actually borrowing the money, right? The interest expense. And if we can't do the substitution, then we've just spent a bunch of money on interest for no gain.
So let me just ask a few more questions because we only have a few more minutes here. If there are pre and post effective date contributions, the person's saying, then upon a grantor's death, do you think there should be a calculation of how much the trust value is included in the decedent's estate?
I think that's the intention, that if there is a contribution after date of enactment, a proportion of the trust would result in would have estate tax inclusion. Now, how do you trace that? Do you base it upon fair market value? Do you do specific assets? That's not clear. That's probably going to be the role of the Treasury Department and IRS to come out with regulations as far as how to do that. But I think the intention is that a proportionate amount, and how you arrive at that again is uncertain, but a proportionate amount would be includable in the estate for estate tax purposes.
Okay.
That corresponds to the fair market value of the property deemed contributed as a numerator, effectively compared to the denominator would be the total value of the assets of the trust, including the contributed amount.
And in fact, one of the new code sections says that. It's just unclear how you do it.
Right.
Yeah.
And depending on the assets, it could be a tricky calculation.
Yeah.
So-
What if there are subsequent sales of it? So it's
Yeah.
very simple. If there's a particular asset that is kept completely segregated and you can monitor it, you know exactly what it is. But what if there's a subsequent sale after that? And how do you apply tracing concepts? Do you apply tracing concepts, or is some sort of election allowed?
Yeah,
Last
be interesting to see
question.
how that plays out. Go ahead.
Yeah, last question, and then we'll wrap it up. Are individuals, we know this is new, this law, but have you come across any individuals considering the use of partnerships to avoid some of the pitfalls of the proposed regs? For example, using a limited partnership to own life insurance.
Well, the question there would be who owns the limited partnership, and does that produce estate tax inclusion? And how do you get cash, into the vehicle to make premium payments? I think at least on the surface, what's being disallowed is the use of an ILET, which is because it's a grantor trust. So if you don't have a grantor trust, then you don't have that immediate issue, but you do have all the other financial questions, right? How do you get money in, and who owns it? And when you get money in, does that constitute a gift? We were playing around with this idea yesterday with my partners, and trying to speculate about how to circumvent the potential new rules. And I mean, the conclusion that we reached was we actually need to see specific language before we can figure out how to circumvent the specific language. So maybe the use of a partnership would help. For sure, we would explore the use of a partnership and any other vehicle to help. For sure we would. But today we don't know.
And I would just add to that mix possibly a C corporation. So you have an irrevocable trust structured as a non-grantor trust. It doesn't confer the power to pay premiums. It doesn't have any of the triggers, doesn't have a spouse as a beneficiary. Or if it does, you use that the adverse party who consents to distributions that in turn owns a C corporation. And the C corporation in turn is the owner and the beneficiary of a life insurance policy. That gets complicated because if upon death, you have proceeds coming in. How do you get the proceeds out without a taxable gain on distribution then? But that would possibly avoid the application of these rules. Presently, you don't have to worry about a alternative minimum tax in that posture. That could change, but that might work. And you could have loans at the C corporation level, which could be a way to achieve the same benefits without any tax whatsoever. But again, let's see how this plays out. But that could be a possible technique.
Thank you. I want to respect everyone's time. So I do want to thank Mary, Kevin, and Robert for giving such an informative discussion. As they alluded to, this is just a proposal. So we need to see how things pan out. If you have any other questions, you can still fire them through the chat box, and I'll try to reach out to Kevin and Robert for specific answers. But if you need to reach out to Kevin and Robert, their emails are on the presentation that will be posted on the Citron Koopman website. And, like I said before, we're going to have another webinar in October on cryptocurrency. And then if people have other types of webinars that they want to hear about, please send us an email and we'll try to set it up. But again, thank you, Mary, Kevin, and Robert, for your time. Very informative, very great discussion. And I thank everyone for joining us. Have a good afternoon.
Okay, thank you.
And good morning in California. So thank you all.
Everyone.